Good morning, and I think I should say thank you for asking me to do this. So I met Dick when I was at Morgan Stanley, and when Peter and the organizers were talking to me about this conference, and we were sort of talking through what was going to be in it, I said there's only one person who can possibly give you the context of the whole conference, and that's Dick Berner. And the reason is that Dick is probably the only person you will ever meet who's done and influenced every aspect of what we're going to be talking about. Just to give you a sense of this, he has built macro models, macro forecasting models in a very major sense. He was an economist at Morgan Stanley where he had to try to predict and then help people make investment decisions based on that. But more importantly, he's the only one of the people I ever worked with who was in that role who actually worked very closely with the individual analysts at the corporate level to try to both learn from them what was different to what he was doing and actually help them to get a macro perspective into it. He worked with the BEA and trying to develop their metrics. We worked with a bunch of companies, and then he went into the regulatory environment to try to actually bring proper analysis from banks, basically, to the macroeconomy. But perhaps most importantly for us is he is the only economist and regulator that I've met in that context who actually believes in the importance of accounting. And he truly knows what he doesn't know and seeks out people like us to help him. And when he's, at the OFR, he brought in people like me to be part of it, and frankly, very few of them wanted to hear what we had to say. So, because it's much easier not to. And so it made sense, at least in my mind, and fortunately the organizers agreed, for you to hear from him, because he really can give us a sense of both what does exist, but more importantly, I think, what could exist and where we can be of help. My friend Dick Berner.
Well, thanks very much, Trevor. After that build-up and that introduction, which is very kind, you're all going to be disappointed, I'm sure, because the hype is too high. But one thing Trevor said that I think really is valid, and that is when he asked me to come here, I jumped at the chance because it's an opportunity, as Trevor noted, to learn from all of you. And so what I'm hoping in the next day and a half is that we have that opportunity for a dialogue where I can learn. If I have something that I can give to you, that's great, but I'm really here in a two-way conversation. So I want to thank the Center for Accounting Research and Education, Trevor, Peter, Ryan Ball, and the organizers for inviting me to this really important conference, and I'm honored to be here. Our discussion is going to be aimed at better integrating macro and micro analysis and information for decision-making at both firms and in the official sector. And so Trevor and Ryan asked me to set the stage for our discussions over the next day and a half. My goals are to provide some understanding of the current state of art or science of both macro and micro analysis, of ways they are used in forecasting, risk assessment, and policy evaluation, of how they can be better aligned, of the nature of information and gaps in it, and of the opportunities for future work. So let me start with a key premise, and that is there is a pressing need for integration of macro and micro analysis and data for decision-making in business, markets, and policy. Both matter, but neither alone is sufficient. Let me be very clear. This premise and this need are not new. Some analysts have been at it for decades, including me. But two things are new and hopefully are catalysts for change. First, the financial crisis really shook complacent decision makers, both in government and in business. And second, the current data and tech explosion, I think, promises new avenues for integration. Let's start with macroeconomics, which is pretty important for decision making. We teach it in universities and we practice it at central banks, finance ministries, and businesses. We use macro models to give us structure within which to test hypotheses, to organize our thinking and to examine policy choices, and these are all critical. Our macro modeling and forecasts aim at understanding macro outcomes, such as inflation, growth, the direction of interest rates, as well as the risks around them, the stuff that I trafficked in for 4 decades. But macro models have failed us. As Andy Haldane from the Bank of England recently noted, during the financial crisis, quote, the workhorse dynamic stochastic general equilibrium, or DSGE model of the macroeconomy fell at the first fence. As I see it, by focusing only on the macro and by focusing on mode, mean, or median outcomes, by assuming away default, by assuming participants are all the same, and by overlooking micro factors leading to trouble, the models and the analysts who use them failed to understand looming risks. Now, microanalysis is also important for decision making. We use micro and micro models to assess product demand or plan business strategy in applications such as risk management, asset allocation, looking at detailed interconnections in the economy or in the financial system, as well as to evaluate policy choices. Increasingly, too, businesses are now using so-called big data sets and the tools to analyze them, such as artificial intelligence, machine and deep learning, et cetera, to explore how micro-level units affect their businesses and the risks that might lie in them. But micro alone often fails us too. The assumptions often made in micromodels have proved misleading, partly because they failed to account for the macro or external factors. That's true in finance, epidemiology, and even engineering, whether the data are big or normal. So what to do? Well, I think the solution is to try to integrate better the macro and the micro so that each informs the other. This is not easy to do. I know I've been trying to achieve that integration in my own work literally for decades. That's because many of the questions I've tried to answer have had both macro and micro dimensions. So that you appreciate the importance of tackling these questions and the challenges in doing so, I'll illustrate with some examples drawn from various stages of my career. For example, as an undergraduate, a long time ago, I wanted to explore whether the formation of the European Economic Community, as it was then known, significantly changed the industrial composition of production and trade among the 6 countries. I'll repeat that, 6 countries, as theory predicted. In my thesis, I used input-output tables to break macro aggregates down by industry and country of origin. I got great advice in doing that. My thesis advisor was Wassily Leontiev, who won the Nobel Prize for inventing input-output analysis. But my approach was by necessity basic and my answers rudimentary. In my forecasting experience at the Federal Reserve, it was important to understand the macro-micro bridge, to make sense of the anecdotes in Fed surveys and reports from the reserve banks. Later, as Trevor noted, as a macro analyst in banks or investment banks, it was important to bridge my work to the micro so that industry analysts, risk and portfolio managers, bankers, and clients could more easily use it. For example, at both Morgan Guaranty, a name that's fallen by the wayside, JP Morgan now, and Mellon Bank, now Bank of New York Mellon, as a member of the credit policy committees, I used credit analysis to forecast credit losses by sector and by product. We could have done it better with better understanding of underwriting, default, and recovery data by sector in some detail. At Morgan Stanley, our top-down forecasts involved a fair amount of granularity, needed to account for special factors like changes in healthcare, technology, and other things. I went significantly further. I always tried to create a two-way street with equity, fixed income, and other analysts to relate macro and micro together. They would use top-down forecasts as inputs, and I would use their industry insight to modify the top-down outlook. We would iterate back and forth continuously as new information became available, and we incorporated analysis of policy changes into the equation. However, I'll confess that this was not terribly systematic or capable of replication, something that I think is important. If we had resources and time, we might have refined it better. The lack of a systematic approach precluded developing what we call bull and bear scenarios, confidence intervals around our basic forecast, that were synced with those of industry analysts. I think that's pretty important. To socialize and institutionalize this work with our analysts and sell it to clients, I created a Morgan Stanley Business Conditions Index that aggregated monthly surveys on a dozen aspects of the analyst firms under coverage: sales, orders, pricing, margins, costs, and so on. It helped get two-way flow going. It informed the macro, and it got the analysts to think about how their companies might be affected by the macro. And it started that conversation. My colleagues and I tried to assess aggregate losses in banks and markets in the wake of the financial crisis as it was really gathering steam by starting from the bottom up. We did top-down cross-checking against those bottom-up estimates, but it wasn't possible to examine the interaction among the components. We lacked the data. We lacked the understanding at that point. We also used data from Discover credit card transactions. Discover was a credit card issuer that was owned by Morgan Stanley at the time to forecast monthly retail sales and consumer spending and understand their composition. But the data were unstructured and incoherent, so they weren't terribly useful for either forecasting or for analysis. Finally, 3 examples from my most recent experience show how apparently well-founded micro stumbled because it overlooked the macro. In firm risk management, value at risk, designed to estimate worst-case losses, proved inadequate in system-wide stress periods. I think most of you know that at this point. Losses were far larger than what value at risk predicted because macro shocks fattened the tails of distribution much more than was assumed by the models. Second, in portfolio analysis, models assumed constant correlations and covariances, and they may have lulled users to think that they were well diversified. Well, guess what? They weren't. Partly because macro shocks radically changed first and higher moments. In stress testing, we assess losses and exposure to them in the face of shocks, both at the firm level and from a regulatory perspective. But it's not enough just to assess direct exposures. To link the micro to the macro, we need to assess spillovers across institutions, borders, markets, or other parts of the system and to the economy, as well as feedback from the economy to the financial system. So these examples underscore that it's worth developing a more systematic approach to macro-micro integration. And the rest of my time, I'll try to spell out some of the needed ingredients. So first, we should be carefully framing and prioritizing the questions that we want to answer. Deciding on the right questions is really half the battle. It will help us focus our resources on difficult problems. The tough ones always seem to involve integrating macro and micro. Here are a few examples away from direct financial concerns. Some are taken from a piece I wrote back in 2004 on America's long-term challenges, and some are updates to that dark vision. First, is longevity a blessing or a curse? Second, U.S. educational outcomes are mediocre compared with the rest of the world. Why? What are the consequences? Third, will we have access to health care in the future, and at what cost? Fourth, is our saving infrastructure and our savings adequate? Fifth, government debt is growing in relation to just about everything. What are the implications? Six, income and wealth inequality are high and rising. Why? What are the implications for our economy and for our society? And last, productivity growth has slumped here and abroad. Why is that so? Will it recover, and what are the consequences? The answer is thus we'll have both micro dimensions for you and macro dimensions for society. I'll have more tough questions in what follows. The second ingredient in micro-macro integration involves weaving both risk and uncertainty more fundamentally into our analysis. And what I mean by that is either in macro or micro, we should not just be thinking about means, but the whole distribution of outcomes. This will be hardly novel to most of you. After all, assessing tail risks is the essence of both modern financial stability and risk management practice. But as either policymakers or risk managers, we need to seek alignment between those two disciplines. The first being presumptively macro and the second traditionally micro. Now, I just finished teaching a course at Stern based on the premise that bridging this macro-micro divide would pay dividends for both sets of practitioners, not to mention for financial stability, safety, and soundness of individual institutions. Just a few words on this. Unlike our models, the world is not normally distributed and homogeneous, so we should not a priori impose unrealistic assumptions about those distributions on our analysis. But there are a couple of things that we should do. We should assess the probability distribution, including skewness and volatility of risk for future outcomes, such as economic growth. We should investigate and embrace modeling techniques that allow us to relax assumptions about the normal, or at least symmetric, distribution of outcomes, agent homogeneity, optimization, and stationarity. The third ingredient in bridging the macro-micro divide involves improving the quality, scope, and accessibility of the data that we need and use to answer these questions. All three are required, like three legs of a stool. Let's first discuss data quality. The collapse of Lehman Brothers in 2008 taught us all a lesson about the importance of data quality. When Lehman failed, financial regulators and Lehman's counterparties were unable to assess many individual exposures to the failing firm. No industry-wide standards existed for identifying parties to financial transactions. So many market participants were exposed to Lehman through its subsidiaries without knowing it. Now we have a solution. The Global Legal Entity Identifier System, or LEI, is like a barcode for precisely identifying parties to financial transactions. It's a cornerstone for financial data standards. Lacking data standards, one cannot aggregate or compare data at the business unit or legal entity level up to the firm, much less the macro level. In other words, standards are required to bridge the macro-micro divide and are really needed. That brings me to the next leg of the stool, data scope. To bridge the micro-macro divide, we need data that are both comprehensive and detailed or highly granular. Although we've made a lot of progress, gaps persist in needing data. Now, to many of you, talk of data gaps may seem pretty weird. After all, we now seem to be awash in an explosive torrent of big data. That's certainly true. 5 years ago, one estimate was that 90% of all data ever created had occurred in the prior 2 years. Moreover, new tools to analyze large, unstructured data sets, as I mentioned earlier, AI, deep and machine learning, natural language processing, and text analysis, offer ways to discover hitherto bettered relationships and conclusions. By examining vast granular data sets, we hope to gain new insights into the age-old questions that span the macro-micro divide. But there are pitfalls. Combining big data with these cool tools can offer seemingly strong conclusions, but they may break down out of sample. More data aren't always the right or high-quality data. In finance, critical information is lacking, or it is incoherent, or at least unstructured. So to realize the promise of big data, two elements are required. First, while we must look to the data to see what they tell us, we can bridge the inductive-deductive divide and improve our decision-making by adopting what Andy Haldane calls a two-way process of learning between theory and empirics, with theory motivating measurement at some times and measurement motivating theory at others, in a continuous feedback loop. Just as we benefit by integrating macro and micro, so too can we advance decision-making by joining theory and data. In addition, we need to assure that data are fit for purpose. That two-way process between theory and data must inform the way that data should be organized and structured for analysis. Firms need to regard data as valuable assets, not just to be safeguarded, but to be subject to appropriate management, governance, and stewardship. For example, financial firms are subject to significantly increased regulatory reporting requirements, as I'm sure many of you know. An appropriate regulatory reporting operating model that includes business, risk management, and corporate finance executives in an equal partnership will facilitate using the same basic data for risk reporting as for risk management and analysis. The final leg of the data stool is accessibility. It's interesting, this morning I had breakfast with Dennis Fixler from BEA, and we were talking about data sharing, something that he and I have tried to accomplish for decades, and it still hasn't happened. This is a major challenge between securing confidential or private data and making data appropriately available to stakeholders, including policymakers, regulators, markets, and the public. This is not just a problem for Mark Zuckerberg. It is a problem for every firm and every branch of government. This may be hard for you to understand, but even inside government, trust and verification are crucial for sharing data. Data providers such as financial firms, domestic regulators, and foreign authorities are reluctant to share data without trusting that, first, the need for confidentiality is recognized, and that, second, once shared, the data will not be breached or carelessly shared further. Verification, even of trusted parties, helps build that trust. Now, I believe that the combinations of focused questions, analysis, that allows for heterogeneous agents and asymmetric outcomes, and fit-for-purpose granular data will enable us to start laying the foundations for the macro-micro bridge. Fusing them will enable us to focus on tail risks and how to manage them. To close, I want to cover 3 topics that may shed light on where we go from here. Identifying successful micro-macro bridges and the data employed, areas in which it is difficult to reconcile macro and micro, and what to do about it, and some thoughts on future challenges. There are many examples of published data that successfully bridge micro to macro. They typically share some key characteristics. The data are structured and standardized so their components aggregate or disaggregate easily, which facilitates meaningful comparisons of components and analysis of their distribution. The methodology for compiling the data is well understood, so users can really understand what they mean and what they represent. Here are 5 examples. At the OFR, we put together a monitor for money market mutual funds, which makes both aggregated and detailed data from the Securities and Exchange Commission on money market mutual funds transparent to the public. The Fed's survey of consumer finance's panel data derived from surveys enables us to understand detailed changes in the distribution of wealth and income over time. BEA industry data attempt to aggregate consistently up to national accounts totals. BEA input-output data enable us to analyze the inter-industry impact of policy changes. And last, the Fed's financial accounts of the United States, including the integrated macroeconomic accounts developed with BEA, and enhanced financial accounts provide a growing array of detailed data that aggregate up to macro totals. This is just the start. Equally, there are areas where macro and macro are much more difficult to reconcile. Granular data and facts needed may simply not be available, and they are unlikely to be coherent and standardized so they can be aggregated up to the macro and compared. Aggregation in economic data may be imposed by classification schemes that are out of sync with each other or out of date. Aggregation in financial data that don't use entity or instrument standards will create, you guessed it, bad data. Solutions aren't hard to find, they're just hard to implement. Data users and data producers need to crosswalk classification schemes so that joining up 2 sets of data can produce coherent results. Innovation means classification schemes must always evolve. When I started in economics, the Standard Industrial Classification System, SIC, was graven in stone as the only one to use. The SEC, the Securities and Exchange Commission, is still using it. Code 3578 in the SIC is calculating and counting machines, which does not include electronic computers. Really? And what about service industries, which dominate our economy? Fortunately, now we have the North American Industry Classification System, or NAICS, which replaced the SIC in 1997. To supplement NAICS, we have the North American Product Classification System, or NAPCS, which covers a lot of service products, as well as goods. But how can we reconcile these with similar schemes in other parts of the world? Some examples of the challenges include, first, we often want aggregate or industry measures of corporate profits against which to benchmark company reports. Going from company to S&P 500 data is relatively straightforward. Translating those to aggregate or industry corporate profits used in the national income accounts is not exactly straightforward. It is doable, but requires a lot of adjustments. The latter derive from corporate income reported by the IRS using a variety of translations and adjustments documented in a 40-page, very helpful memo that Dennis and his people have put on their website. Second, client needs. Clients want macro translated into relative value and industry comparisons, and as just noted, the basic data for each are not easy to reconcile. In risk modeling, CROs want consistent risk assessment across the enterprise. That's difficult unless they implement a top-down, data-driven process woven into each business unit. Last, stress testing. Firm stress tests are too often inconsistent with those used by regulators, and neither incorporate system-wide feedback effects. That's a big challenge. More challenges. The biggest are, I think, those related to data. Evidence-based decision-making, a buzzword now in analysis, needs coherent evidence, and if we are to bridge micro-macro, we must have data that we can compare and aggregate. Second, the lack of coherent data will increase the temptation to data mine, especially in new big data sets because data aren't sufficient to fit a structure that might be used to test hypotheses. They may show correlations at a point in time which could lead to erroneous conclusions. Now, that's not to say that unstructured data aren't useful. After all, Newton discovered gravity just by looking. Kepler evolved his laws of planetary motion by first looking to the heavens, so we all need to do that. Data used as descriptions of issues will always be helpful, but we must take care to recognize that they may be incomplete. And finally, don't assume that data collected by the government or possessed by industry are always comprehensive or clean. They haven't necessarily made, largely because they lack the wherewithal, the investment in either attribute. I think that's particularly true at the firm level, maybe less so today at the government level. Well, I've tried to provoke you a little bit this morning, so in our discussions on other panels, you will grapple head-on with new ideas, difficulties and risks, and opportunities in bridging macro or micro. So let's get going. I'll be happy to answer a few questions. Stunned silence. Trevor.
So given all that you've experienced, do you think we should, two parts of the question, should we be comfortable that the stress tests tell us anything about real stresses? And related, so the first question was, given all the data issues and the micro to macro mismatch, if you like, and the lack of understanding of correlations and counterparties, should we be comfortable that the stress tests give us any sense of managing through the next problem, number one? And two, how much of this is because unlike the French system maybe, the accounting systems are idiosyncratic to firms, and getting them into an aggregate is virtually impossible, even if they make that investment?
Those are big questions. Let me answer the first one first. I think the answer is yes. As my former boss, Tim Geithner, used to say, plan beats no plan. And stress tests, having stress tests, however imperfect they are, and they always will be so, is better than not having any stress tests. There's lots of work left to do to make them better, and the evolution has to continue to proceed, particularly as the financial system and the economy evolve. But stress testing is a vital tool, and should remain so, as far as I'm concerned, in assessing what the tails of distribution really look like. So we just have to be cognizant of the assumptions that we're making and the implications for, what they really mean. And we have to assess where the data limitations are and what we need to do. Can we be confident that, accounting systems are, going to help us aggregate up from the firm level to, to the macro level? Well, I think that's a job for all of us in this room. We need to do a better job. In stress testing, there's a good example lately that I think is important. So IFRS 9, which has just been implemented in Europe, will require financial firms, banks in particular, to account for future losses by making projections of those losses. And they will be incorporated into stress tests at the micro, the firm level, as well as in the supervisory context by the Bank of England, the ECB, the European Single Supervisor, and so on. And I think that's important. We have something similar, as I'm sure all of you know, in the United States called CECL, or CECL, which will do something similar. And my perspective is that having something that's forward-looking as opposed to backward-looking is probably a good thing in terms of where our assessment of risks might lie and where the vulnerabilities in the financial system are. Inherently, however, those projections we ought to look at them carefully and make sure that we have an understanding of the methodology that we use, an understanding of the data that we're using to make those projections, and an understanding of what could go wrong. In the back.
So Taleb has this book called The Black Swan, where he talks about these tail risks, and one of the points he makes is that the world is complex, and every time you try to fix something with a regulation, you're creating a weakness somewhere else. So your stress tests, by definition, are looking backwards at the last crisis and don't really often take into account the fixes you've made that may be creating the next crisis. So how would you deal with this?
I completely disagree. First of all, I think that if you start from the premise that the financial system is inherently unstable, which is where I start, and that regulation is required to make it more stable, that's a very different perspective than the black swan idea. The black swan idea, I think, is based on the idea that we can't predict shocks. Completely agree with that. But what we can do is identify where there are vulnerabilities in the financial system, and we can try to make it more resilient when shocks occur. We also can't predict when they're going to occur or exactly how they're going to occur. So one way to deal with that, and by the way, I don't agree that stress tests are backward-looking. I think stress tests are intrinsically forward-looking. They need to be. What the risk is that if you design scenarios that basically are drawn from the past, that they will be backward-looking. So what you need to do is to think about scenarios that you didn't think were likely or plausible that go out into the tails. And you need to probably do reverse stress testing, which will look at all the range of possibilities, perhaps using Monte Carlo simulation and a bunch of other tools, to go out and to see what the range of possibilities might be and look at the ones that will kill you. And I think that opens your eyes to the possibility that, here are some vulnerabilities in the system. Has to be forward-looking, but we have to be humble about the extent to which, we're going to be good at this. We're better at it than we were. We were clueless before the crisis. Now at least we have a clue. Yes.
Just following up, actually, from both of Trevor's questions, on the concept of aggregation of corporate accounts into macro data, how much confidence can we have that the law of large numbers applies here? So inasmuch as there are idiosyncratic assumptions made or forward-looking projections made, can we be confident that they're going to cancel out either in cross-section or that in time series the aggregate error is going to be uncorrelated to the overall cyclical position? And second, just a straightforward question on stress testing as the world's biggest expert on it. Do you think that the stress test models should be made public? And if they are, what's the risk that they become another regulation to be gained against?
So I'll answer the second question first. Definitely, I think if you make the model completely public, then people will game them and they will use the exercise as a check-the-box exercise. They will manage to the model. So there are two aspects to that. One is, do you make the shocks, do you vary the shocks from time to time? The answer is yes. Do you make them more severe over time? The answer is yes. And they have been made more severe over time. The firms are complaining about that, but they failed to understand that at the beginning, the tests were easy to jump over and weren't terribly stringent. And now we're getting them up to speed and making them more severe. And good risk managers, and this is where the micro-macro bridge really comes in. Good risk managers, good CROs at firms understand that, and they are making their stress testing internally more comprehensive and more stringent. And they're looking at scenarios they never thought were likely before. To come back to the first question, the accounting question, that's something that we should discuss over the next day and a half. I think that it's always going to be a challenge. But if we don't start with, high-quality, comprehensive, granular data in which we have confidence and we understand, we're not going to get there. And so we need the basic building blocks of doing that. We need to share data among regulators and among the statisticians who create the macro data so that they can better explore the company data that are really available there. And we need to make sure that people understand the limitations of our data and what they really represent. I think statisticians have generally done a pretty good job of helping to understand that. For example, they publish confidence intervals around the data. They make it clear that, notwithstanding the press and elected representatives to
I don't think people really, I don't know how much everyone's been involved in doing consolidations in a company, or actually know. The inability to actually get behind, equity accounting, what the FASB and ISB have been working for 30 years to try to solve the consolidation problem. There is no way to do it so that you actually get the representation. Look in a cash flow statement. There's no way you'll find minority interest. So what does it mean? Okay, so the problem is that even internally, people don't have a clue, honestly, if there is aggregation that takes place on a consolidation. And with all these legal entities you're talking about, all the interactions between them and the way they allocate across, it's crazy.
So let me say two things, Trevor. First, I defer to you because, I've learned everything I know about these issues from you. But second, you make it sound hopeless that we should just throw up our hands and we should stop working on this.
Our challenge is to try to sort it out, but the problem is people are relying on numbers they're seeing on the presumption that we worked it out.
No, that's right. That's basically what we're on the same page on that score. We need to understand the limitations of the data. We need to understand that these data should be regarded presumptively as flawed and as estimates, and that there's a range of uncertainty around the so-called information. People do not do that. People do not understand that. And we need to make them aware of that. And we need to do a better job, I think, at the basic building blocks of putting these things together. Anything else? Well, it sounds like we've got a lot of challenges for the next day and a half, and I'm glad I'm here to join you to talk about them. Thank you.